I was working along with others at a big Wall Street, what we thought was a very big firm called Cleary Gottlieb Steen and Hamilton, a big international law firm. And a group of us got together, 4 from that firm, 2 from another firm, and 1 or 2 others, and decided to create our own boutique law firm, thinking, well, we're leaving firms that are much too big. And we laugh about it now because our firm is well over 400 lawyers, maybe 425 or 450, and those firms are 700 or 800. So law firms have grown just as the whole investment banking and financial world has grown. But even though we set out to create a boutique, when we did that with the knowledge that we were starting with very few clients. But one of our major initiatives had been, even before we started the firm, which we carried through to the firm, was representing hedge funds. And in particular, our first major iconic hedge fund manager was Michael Steinhardt, who ran a firm which was then called Steinhardt, Fine and Berkowitz. And they continued with us, and that led us to start representing many hedge funds. We noticed that a number of our clients were opening offices in London, that whereas there were only 1 or 2 hedge funds in London at the time, that there seemed to be an interest in creating new hedge funds. And so we felt, to protect our franchise, which was the biggest in terms of hedge fund representation in the US, it would be important to move over to England and have an office here on the site of the development of a new hedge fund practice in the UK. I think there are only 2 or 3 hedge funds in existence then. And there must be 300 or 400, 500 today in and around London. So we found a wonderful hedge fund lawyer named Chris Hilditch, who had been at Simmons for a while and was a partner in Maples & Calder London office, which Maples & Calder being a major offshore law firm for hedge funds. And Chris said, look, I think you guys will do well here. You've been in this business for more than 30 years, but you need to send someone from New York to integrate your, what was then 60 to 70 hedge fund lawyers with what we set up, which will be a much smaller office. And for a variety of reasons, I volunteered. I won a little competition with a few others who wanted to come and decided to come here for what I thought was 2 or 3 years. It turned out we're now in our 12th year here, because that was 2002. And very good activity, and lots of good people have joined us in this practice here. I think if you had to pick one word to describe what's happened to the hedge fund business, it is institutionalization, broadly defined. In the days when Michael Steinhardt and George Soros and then Julian Robertson had the Tiger funds, which we did a lot of work for, and then the Tiger Cubs, who were the next generation who spun out of Julian Robertson's office. Most of the clients, or investors I should say, were high net worth individuals, occasional family office, but it was mostly high net worth individuals. Institutions didn't pay much attention to hedge funds, and I think we're nervous about hedge funds in the early days. But as the institutions, and here I'm talking about pension funds, large endowments in the United States, there must be 200 endowments of size that invest in hedge funds. We're looking for professional money management, and for a lot of good reasons, hedge fund managers tend to be among the best managers of money. And also, the hedge funds were hopefully designed to protect against downside movements in the market when that happened, as well as capturing alpha on the upside. So a lot of the institutions who've hired professionals and outside consultants have stayed with a hedge fund as a part of their business. Some of them have been disappointed, as others have, that in the last few years, the long-only managers, whether it's a mutual fund or a unit trust here, have done better by not hedging, by not having any short sales, because the market's been so ebullient and strong. And there's been a whole discussion in the news, including the hedge fund journals and others, about whether institutions will continue to be faithfully invested in some large percentage in hedge funds. CalPERS, which is probably the biggest single pension plan announced that they were getting rid of what was a pretty small allocation to hedge funds, 4%, I think. And a Dutch pension plan also said that. But many others of the institutions, pension funds included, have stayed with their hedge fund investments. And their reasoning, I think, is in part that they recognize that the market's been very strong, as I said, but that there's going to come a time when, if I knew that, I'd be managing hedge fund money instead of being a lawyer for hedge funds. But they remember that in 2008 and 2009, the hedge funds didn't do very well, but they did a lot better than long-only managers. The hedge funds might have been down 15 to 20% in that period, but long-only managers, on average, were down 35 to 40%. So I think that the people who run institutional money recognize that it's important to have some hedged investments as part of their portfolio. The seeding, the providers of seed money, which is really critically important for people starting up new hedge funds. And we can talk about who they are. They range from people leaving other hedge funds to people leaving proprietary trading desks where they can't get paid sufficiently, people who recognize that there's significant money to be made and that there's a lot of flexibility that comes from being a hedge fund manager. But they need to have significant upfront money to be able to be in business. The estimates are that you need anywhere from 75 to 100 million or maybe more to just get in business today with all the regulatory and other requirements. Who are the seeders? Well, there have been some smart bankers and investment groups that have put together funds that would provide seed money. The biggest seeder probably today is Blackstone, the US public company that does a lot of hedge fund activity and fund-to-funds activity. There has been a diminution in some of the seeding activity by specialized funds, and that slack has been taken up by a combination of investors, which could include, in fact, some institutions who see the opportunity to make an early investment with a great manager as a way of not only making money on their invested money, but by participating in the revenues, gross or net, of the manager's activity. So the seeding providers have changed a little bit. Family offices, which we'll talk about, have been the source of seeded capital. Very often managers will start with friends and family raising 20 or 25 million to get into business and then going out to seeders to raise the additional money. So it's a varied source. It's a very difficult subject for people starting up today because there are only a few institutions like a Blackstone who are still in the business. Some of the prime brokers are providing seed money. So you have to just have a lot of savvy about where to go and where to look for the upfront money. Every time you have a seeding transaction, usually the seeder provides a term sheet. This is what we want. And then there's a negotiation, and we help the new hedge funds negotiate those deals. And a big issue is, should a hedge fund manager take money from a seed provider who wants to have a share of all the net profits? And the problem with that is that may be the fairest way to do the deal, but that means sometimes the seeder is going to insist on some kind of say about, well, who gets paid bonuses and how much on the bonuses and who gets paid for administrative activity and that sort of thing. They really interfere in the operation of the business because it affects their share of the net profits. A deal which involves sharing in gross revenues, by definition, doesn't involve any impact of the seeder saying you have too many expenses, because they're getting a piece of the gross revenue, and they don't care what the expenses are because those expenses are being paid for by the hedge fund manager. I think you could say it's almost a 50-50 division as to whether it's a gross deal or a net deal, and it depends a lot on the inclinations of the seeder and how much leverage the hedge fund manager has. We try to move our hedge fund managers in the seeding deals towards the gross deal, and we do that primarily because we think it's better not to have the seeder involved in every decision-making opportunity in terms of expenses and that sort of thing. Well, traditionally, the structures have been very much Cayman offshore funds for non-U.S. investors and U.S. tax-exempt investors from specific tax reasons they have, coupled with a U.S. partnership, typically Delaware. And that bifurcation is because U.S. taxpayers have to pay their taxes every year, unfortunately. And so you need to have a fund structure that will be a pass-through vehicle, partnership, so that the actual income of the year can be passed through and reported by the U.S. taxpayers. Whereas the offshore investor typically, and the U.S. tax-exempt investor, don't pay taxes currently. They only pay taxes in the case of offshore investors. U.S. tax-exempts may not pay taxes at all, like pension funds, when they redeem out of the fund. So you're marrying one fund that is a partnership fund where there has to be a reporting of current income, and an offshore fund where it's not really relevant how much current income there is, but rather people pay taxes when they come out of the fund. And the way that's done is through a master vehicle. The two funds come together because it's not efficient to have parallel funds that invest at the same time, because that means you have to split every ticket and make decisions and balance each portfolio every time you have new money coming into one fund rather than another. So that's been the traditional structure. Some investors have felt that Cayman is somewhat tainted, and so they want to be in Luxembourg or Ireland funds, which are heavily emphasizing some regulatory oversight. We see some of that going on, and so I can't say that Cayman is always the choice, or British Virgin Islands, which some people have a preference for, but there still is a significant amount of offshore fund activity for investors wherever they're from. Now, you mentioned single manager funds. When institutions invest, very often they say, look, we don't want to be coupled with all the other investors who are in an offshore fund, so we'd like to have our own fund with you. It's called a fund of one. And so if an institution comes to a manager and says, we have $100 million we'd like to invest, but we'd like to have a more bespoke kind of investment and talk to you about what you invest in, very often the managers will set up a separate fund that may co-invest or invest alongside a master fund, but which would be separately dedicated to the needs of that particular investor. The UCITS phenomenon is out there, and some people have followed it. It's much more available and used by retail investors. Part of the problem for hedge fund managers is there are UCITS requirements that require significantly greater liquidity for investors. They have to be able to come out of the fund every two weeks or every 3 weeks. Same with mutual funds. In the U.S., there is a huge mutual fund industry. It dwarfs the hedge fund industry by 20 times. And some of the mutual fund managers who are good managers have adopted some of the techniques of hedge fund managers. So you have liquid alternative mutual funds that use short selling and use a lot of the same techniques that hedge funds do, but they also have to be able to allow redemptions almost daily for their investors, and they're subject to significant regulatory requirements. So some very good hedge fund managers have stayed away from doing the alternative mutual fund or the UCITS structures. Others have said, that's another whole source of money for us. Why don't we tap into that by running a mutual fund or by running a UCITS fund? So you have parallel developments, and then you have these bespoke funds or even co-investment funds for some institutions, all being organized at the same time, so that the structures that people use have become much more plentiful. And when hedge fund managers talk to us, we go through all the different possibilities. Many of them say, if we're doing a startup, let's just do a straight master feeder structure with a Cayman feeder and a US Delaware feeder. And some say, no, let's talk about something more complicated. We have seen a trend of some of the smarter hedge fund managers saying that they want to try being private equity funds. The big difference is that a hedge fund manager marks to market the total portfolio and takes an allocation or a fee of 20% or whatever the fee happens to be, and that's a subject we could talk about because there's some pressure to reduce that fee. But others are thinking about changing their structures to to deal with retail investors and other kind of investors. So we still see a significant amount of traditional hedge fund activity, but there are newer structures that people are using. We've talked about UCITS, we've talked about mutual funds, and so they're really a combination of different possibilities that people are using. Well, the reason why tax receipts have gone up is, I think, related to what I referred to before. There's something called the investment manager exemption, which says that if if a UK manager is managing money of offshore funds, in order to be sure those offshore funds are not taxed because discretion is being exercised over them here in the UK manager must bring the customary rate of remuneration, which is pretty much interpreted as the full amount of fees that are generated by that activity. As UK hedge funds have grown and developed, and even though some of them have opened some of their operations in places like Switzerland and Guernsey and Jersey, inevitably the taxes that are derived from the activity that goes on in the UK will increase. So your question really implies the question, do I think there are going to be even more hedge funds set up in the UK than have been set up before? Because if they are constant as they are now, there will still be revenues, and the revenues that are generated will depend on how much profit is earned by the manager as a result of the carry or the incentive fee that they get from the offshore funds. So there are really two parts to that. One, how well will the UK managers do? And it's not been a great last year or two to generate the fees that Emma made reference to, which were significant, but which could be bigger if the profitability of the funds and therefore the carry, the 20% carry or whatever the calculation is, comes back to the UK. And the second thing is how many new funds will be set up here. Legitimate structures that are used for certain kind of investments. For instance, funds that are set up to acquire debt instruments, distressed debt or debt that's paying interest but has diminished in value because the companies aren't doing too well, which happens to be the situation in Europe, and a lot of US as well as UK managers are now investing in distressed debt in Europe. So one of the things we get asked, and the accounting firms that we work with get asked, is, okay, we bought debt in Germany or Switzerland or France, but most of that debt is, the interest on that debt is subject to significant withholding taxes. And so if a Cayman fund, which is where we run our funds from, owns that debt, there's no treaty that would reduce the withholding tax, which could be as high as 30%. So some of the funds have used a structure where they interpose, by creating a subsidiary, a Luxembourg company, let's say, which has a whole string of tax treaties with Germany and all the other countries that I've mentioned, and all the European countries where these debt instruments may be acquired from. And so the argument that the Luxembourg subsidiary's parent makes, the Cayman company that set the subsidiary, look, this interest is legitimately coming to a company that has treaties with all these other jurisdictions which reduce the withholding tax or eliminate it. And I think that the area of controversy around the use of, let's say, Luxembourg or Netherlands to hold positions in debt instruments, and there's some of that done for equity investments also to reduce the withholding tax on dividends, is how substantial, how robust is the activity in Luxembourg or Netherlands or wherever these intermediary treaty countries have entities set up. And so we advise our clients, if you're just going to open an entity in Luxembourg and you're not going to have a process for reviewing and deciding on what investments to make, and you have directors and an administrative apparatus in those countries, you're going to have a hard time convincing the tax authorities that there shouldn't be withholding tax. So a lot of this is going to depend on whether the hedge funds are willing to spend the money to have the robust structural apparatus in place so that they can legitimately justify using the treaties to reduce withholding taxes. And treaty shopping is an area, we've touched on some others, where a lot of the taxing jurisdictions are focusing very hard on whether they can attack the treaty shopping and the use of treaties because it's reducing their revenues, and everybody in Europe just like everybody in the rest of the world, is looking for new revenues and don't want those revenues to be diminished by treaties that are, in their view, being misapplied. Well, we have a very active pro bono program, especially in the United States. We, in fact, have a partner who comes from the pro bono world and runs a major practice of pro bono activity, and our associates are required to participate in that. I must say that we're less involved in that in the UK. Some of us are involved in all sorts of charitable and other philanthropic activities. It's less organized here on a pro bono basis, but I think that the pressure, good pressure, to do pro bono work will continue, and we certainly have adopted a significant pro bono practice in the US, and I think that that will spill over into the UK operation over time.